Hello, everybody, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on June 3rd. My name is Ian Saunders, and joining us as well again today is Will Gibson. Will, it's good to have back-to-back weeks that we're sitting here looking at each other face-to-face. For those that are watching these in a consecutive fashion, you notice we flipped sides of the desk this time, so we still got to do something to keep it interesting.
I did notice that. I did feel honestly a bit weird sitting on this side of the table. I just walked in, your stuff was over there, so I guess we're shaking it up today.
Got to keep people guessing, make sure they can tell the podcast apart, I guess. But there's been no shortage of movement. Again, it's been a frequent thing that we've been saying on these podcasts over the course of the past week. We've seen the rebound. Last week we were talking about some of the near term and some of the intermediate term indicators that we have on the site. We're starting to swing a bit higher. We've gotten some of that movement continued over the course of the past week, which we'll dive into here kind of throughout the duration of this podcast. But I mean, we're looking at the broader SPY ETF trust, that S&P 500 ETF has shown a gain over a trailing 7-day time frame, up 3%. So kind of continuing some of those gains that we got there towards the end of May. However, if you look throughout the whole month of May, you saw the S&P 500 was about flat. Right. I mean, we were at the SPY gaining 0.23% for the month of May. It certainly didn't feel that way. There were some points where it had some solid gains, had some points where it had some solid losses there over the course of the fifth month of the year. But there's a lot more movement underneath the hood, and change has led to some changes on some of the indicators that we'll dive into here. One of those main changes that we saw was last week. We were talking about some of the bullish percent and some of the high-low charts swinging higher. We were waiting on some of the positive trend indicators to swing higher. And we did get some of that further follow through to the upside. So one of the main ones that we follow here is the percent positive trend for the S&P 500, which for those that might not be familiar, simply takes up the measure of the percentage of stocks in the S&P 500 that are trading in an overall positive trend on their default charts. That reading fell from a high in April of 2021. It was up at 92%. And it fell all the way down to a level of 34% with movement in May. Generally, the 50% threshold is really kind of a line of demarcation that we monitor. You see the S&P 500 gets the bulk of its gains when PTSPX is north of 50. Movement below 50 tends to indicate, okay, this is a weak market environment. So it's something that you want to be more cautious toward. And we did see that movement below 50 occur earlier this year, fell down to that 34% level. And then with movement over the course of the past week, we got a reversal back up into a column of X's, currently sitting at that chart level of 42%. So historically, reversals back up on the PTSPX chart have generally worked out pretty well. Now, they haven't worked out perfect every time. No indicator has, but I mean, it's been a good market environment, good places to buy at least some things.
Right? Yeah, for sure. Like you said, the broad index performance this year and over the past month really didn't tell the story. You're up marginally, and it was not a clean marginal gain by any means. But back on the indicator conversation, like you mentioned, the positive trend rolled higher. We've seen some other, I'd say, longer term indicators show some improvement. So it's not just the near term absolute indicators that are improving. You're getting some relative improvement. And what I mean by that is you've seen a lot of bullish percents, 10 weeks, high-low readings flip back up. And those are all absolute based. So they're all absolute price movement. They're not relative to how other things are performing. That's saying on an absolute basis, if a stock is on a buy signal, on an absolute basis, is it above its 50-day moving average? What percentage of names are doing that? But some of the longer term stuff that's relative strength based that we don't talk about a ton, one of them is RS and X's. So it's indicators that are talking about what percentage of stocks are in a relative strength column X's versus the market. So that's a fancy way of saying, is it having greater price strength than your benchmark S&P, for example? Mm-hmm. And you've seen some notable ones reverse up over the past week. One of them being for the New York Stock Exchange, RSX for the New York Stock Exchange, and the percentage of stocks now in a column of X's on the New York Stock Exchange versus the benchmark is moving higher. And I bring this one up because it kind of dovetails into a different conversation that we're going to get into in a second, is that we've seen a lot of laggard areas pick up a lot of volatility. On the downside, they've gotten beaten up, and then they've used that volatility in the recent week or two to the upside. So bouncing, and they've had a lot of, I'd say, relative price strength in the near term, and they've been able to outperform the market. So you're seeing these reversals higher, like with this RS and X's for the New York Stock Exchange. A bulk of the contribution from that was from your consumer discretionary and technology sectors in particular. The vast majority, about 50% of the stocks that moved back into column of X's on their RS chart that are on the New York Stock Exchange were from consumer discretionary and technology sectors. So yes, that's a positive to see the long-term indicators like that move higher, not just absolute base, but relative strength base. You're seeing some outperformance apart from the benchmark, but I think it's important to be careful to look under their hood and say, well, what's actually driving this? Are these laggard rallies, or are these continuation of strength?
Yeah, certainly. I mean, you can looking back at some kind of performance rankings too. You can see over the course of the month of May, when we talked about that, you had the S&P about flat, right? Well, a lot of the themes that we saw throughout the year, your kind of commodity related areas showing some strength. I mean, those are the places that have continued to hold up a little bit better from that relative strength perspective on the longer term picture, right? Because you got the RS and X's and you got the RS positive. That kind of shows that longer term view. And you saw some of those areas that have done the best throughout the year. Energy is the best performing area on a year-to-date basis. Was also the best performing sector representative in the month of May. Utilities, financials, some other areas that have continued to hold up a little bit, at least better than others throughout the year, were also some of those better performing areas there throughout the month of May. So at least it is a good sign to see some of those trends at least continued as we getting this bounce off the bottom. It's not that we're seeing the sector rankings, I guess, or the sector leadership hold up. That aspect of leadership is different now than it might have been a year ago.
Yeah. Oh, yeah, certainly. You've seen momentum and leadership as a whole change a lot over the past year. What you're thinking is high momentum stocks now are likely not the same stocks that were last year. A ton of high momentum names now are going to be your energy, utilities have picked up, some real estate, other defensive sectors are high momentum. And then you've seen a big downshift in technology exposure and high momentum indices. So some notable trend changes there. But towards the month of May, talking in indicator wise, something else I was going to kind of mention on that relative strength and X's discussion is that the continuation that you said. So the derivative of commodities, if you will, like energy, that still had a lot of high participation. Those stocks were already in column of X's versus the markets. So they are already had favorable relative strength. Mm-hmm. It's just some of these laggard areas that have used that volatility in the most recent week to gain reversals higher. Like the electronics subsector is, I think, a prime example of this. Currently, 40% of stocks in that electronics group are in a column of X's versus the market. So they're seeing favorable near-term price strength.
And what is that at for like energy?
For energy, that's like 60% right now, and it's been there. And that's for the broad energy sector. But if you're looking like electronics, so not just column of X, but if you look at relative strength buy signal, so a longer term indication of strength for electronics, that's at 27%. Wow. So that longer term indication of strength really isn't there for those laggard sectors, just kind of confirming some of the laggard.
And that's at RSP indicators.
Yeah, RSP.
Yeah, and that's, I mean, we've seen that, right? You're seeing stuff that, and we talked about some of this last week. I mean, even with these indicators reversing higher, we're seeing some of the stuff that we talk about wanting to happen is happening, right? Your high lows are reversing up, your BPs are reversing up. We got the PT SPX indicator reverse up. We're seeing some of these other near-term indicators reverse up, but it isn't necessarily changing the long-term picture for some of these areas, especially some of those areas that have been out of favor. And like we touched on too, I mean, even if you look at it on the individual sector perspective, or you can say, okay, technology's been out of favor. I get it may not be in favor currently. Doesn't mean there's not going to be areas within technology that you can still look toward, but they may not be the same areas that you might have been looking toward. I mean, you and I were talking about, going through and looking at a couple different stock relationships. I mean, I think a good chunk of the calls, at least that I've heard over the past week, and looking at, okay, can I pull the trigger on Amazon? Is it ready to pull the trigger on Amazon? And I feel like that has been coming more partially from the advisors that are calling in, but a lot more that I've heard, okay, I have clients asking to buy this. Is it time to buy? And I mean, you look at the chart picture of Amazon and you're saying, okay, it was a leader throughout most of the past several years, right? It saw some sideways movement throughout the course of the 12 to 18 months prior to this big downturn. And it's now down 27% on a year-to-date basis, even after a significant rally there that we saw at the end of the month of May. I mean, that name is just not the technically sound area that you really kind of want to be looking for to hold up on this rally. Because if it holds, great. But if the rally doesn't hold up, then there's laggard areas of the places that at least show the potential for further declines kind of moving forward.
Yeah. Yeah. And a core tenet of momentum and trend following and what we do here and why it works is that you're cutting your losses short and letting your winners run. So names like this that have been in portfolios for who knows how long are uncomfortable to sell by all means.
Yeah, I mean, you saw Amazon was on a market, it gave a market relative strength buy signal in, I believe, 2006 or 2007. Yeah, so I think it gave a market relative strength buy signal in April of 2007, I believe.
Mm-hmm.
Gave a string of consecutive buy signals, gave its first market RS sell signal in May of this year, and since that April 2007 timeframe. So I mean, you're talking about a long-term market relative strength winner. I think that was in the long term. You're looking at that RS positive, right? I mean, it was on that RS positive in its favor for well over a decade.
Yeah.
And that flipped over the course of the past week. I mean, other relationships you're seeing, I mean, Amazon dropped from a 3 for 5 from a technical attribute perspective down to a 1 for 5, kind of beneath that technically sound criteria. There's just going to be other areas that you could potentially kind of look to capitalize on this rebound.
Yeah, exactly. And it's like I was saying before, this is an uncomfortable name, I think, to get rid of or talk about if you get a lot of questions about it. But it's important to remain objective as we can here. And like I said, the benefit of the process is cutting losers short and letting your winners run. So that's going to be key when you're looking at Amazon. Another name that reminded me of a similar picture was actually JP Morgan. That was a leader in the finance space for a while, not necessarily as laggard of a sector, but like technology or consumer discretionary. But by all means, that's a one attribute stock right now. It was on an RS buy signal for not as long, about 6 years or so. That rolled over earlier this year. Mm-hmm. Downtrend, you've seen a lot of head fakes on that chart. Like Amazon, you've seen these small rallies, but nothing's really matriculated to a longer term change of technical picture, I'd say.
Yeah. And then you get some other names too. I mean, like in looking at just because something's in technology, I mean, we said a lot of bad things about technology over the course of the past couple of weeks, but we're not saying that necessarily all tech stocks are bad, right? I mean, some stuff has held up better than others. Seen a lot of those names move to negative trends. Some of them have still kind of maintained favorable attributes, but other areas have held up relatively well. I mean, you look at like HP Inc., ticker HPQ is one of those. It's been trading in a pretty tight trading range, but we've seen kind of movement throughout the course of the past year. You're showing still 7% gain on a year-to-date basis, move back to a buy signal with movement yesterday up at a chart level of 40. Yeah, pretty solid support offer there at 34. So, I mean, when you think of tech, you think of big growth, right? And this is certainly not showing that, but it's not showing the big declines that you've seen in tech throughout the course of this year, which I think is more important at this point.
Oh, yeah. Yeah. I think the strength this year, it hasn't just been on the absolute front, it's been on that relative front. So what's held up relatively better, if something's down 5% this year, it probably looks pretty decent,
right,
on a technical picture. But to your point, if you look at like the Nasdaq 100, there's 23 stocks that are 4 and 5 attribute rated, so buy or strong buy rated in the Nasdaq 100 right now that are also in positive trends. So there are opportunities. We've said this before throughout this year, but this is a good environment to add value, add alpha, even because technology in particular, discretionary, some of these mega cap names that have been winners for so long aren't working. And they're these heavyweights and these passive indices and a lot of benchmarks. So being able to get away from those individual stock selections, sector overweights, creates a lot of opportunity again to add value and add alpha.
Yeah, absolutely. It's a lot of times it definitely matters what you own, but it matters a lot of times more so kind of what you don't own, right? Kind of eliminating exposure, and especially like you said, if it's such a big weight and it's something that's going down a lot and you don't have it, well, I mean, that's an automatic benefit for you or for your client's portfolio there.
Oh yeah, certainly. I mean, this year, if you look at stepping out back to sector, energy's up 60% year to date, just spider fund and energy, just discretionary is down 25. Comms down 23, tech's down 20. So avoiding some of those areas, and no, those are some of the biggest weights in the S&P. So like to your point, being able to at least underweight those areas has been a huge advantage.
Yeah, certainly. And I mean, we try to communicate some of those underweights or those kind of potential areas through some of the movement on the podcast. We also do a lot of that on a weekly basis, really, in that daily equity report as well for those that are subscribers to the site. And we'll certainly continue to keep everybody up to date with that. Any potential changes, because like we said, I mean, we are looking to follow trends. Those trends may change.
Yeah.
At least we're seeing them kind of persist with movement, at least that we've seen over the past couple of weeks.
Yeah, for sure. Continuation of that trend. Parting shot here, maybe some sector movement to watch, and then we can land the plane here. Some things to watch again on the sector front. I meant to say this earlier, but we'd like to see some of those defensive sectors cool off a bit. Staples, utilities. Typically, you don't want to see those defensive sectors rocking and rolling in a recovering equity market. So keep an eye on that. Keep an eye on those relative strength-based indicators. So not just the absolute stuff that's rolled over, like the trends, the bullish percent, but watch the relative strength-based stuff and make sure that it's leadership with good relative strength and not beat up areas that just have a lot of volatility and are giving near-term column changes. So that would be my parting shots for today if I had to give them.
Yeah. I mean, all good content and good stuff to watch out for. And yeah, I think that wraps up. That's what we're looking to cover here today, Will. I'm sure we'll be back next week with the same starting words. No shortage of movement for stuff to talk on. Maybe we'll flip the table around next week and be looking at each other long ways. You never know. So
I like that idea. Yeah. Paint the wall or something.
Right. We'll figure something out to keep people interested, because market's definitely not as interesting enough.
Yeah.
Well, as always, we want to thank everyone for joining and tuning in to us this week. We'll be back next week for the second podcast in June.